Let's Talk Money.
Hello and welcome to Let's Talk Money, your weekly personal finance date with me, Surabhi Upadhyay. The first ever mutual fund stress tests hit big headlines last week. And that's because this is a whole new paradigm for investors looking to invest in either mid-cap or small-cap funds. Now, these stress tests tell investors how quickly they can expect to get their money back in case of market volatility and in case there's a big fall and there are heavy redemptions. But it's not just liquidity. Mutual funds will also be making certain additional important disclosures which will give investors yet more data points that must be considered before making that investment call. But how do we assess all of these data points? How do we decide which is the right mid and small cap fund to be in? So to answer all of those questions that we've been getting, to take up your queries, we have with us on the show today Feroze Azeez, Deputy CEO at Anand, Rathi Private Wealth, and Mohit Gang of Moneyfront. Thank you very much, gentlemen, for joining in. Mohit, great that you're here with me in the studio. And hello to Feroze on the wall over there. Feroze, good to have you join in digitally. And I must say that the last couple of days have been, I think, fairly stressful for the industry at large, for investors as well, because everyone's been trying to make sense of the first round of these stress test results. So I want to start by getting your opening thoughts, and then we'll straight away dive into the questions because, as you can imagine, we're getting plenty of them. So Mohit, first thoughts, are these stressful results?
Hi, Surabhi. Honestly, I think March any which ways is a month of stress, and there isn't any dearth of stress all across, whether it be our industry or any other industry. But yes, I think the SEBI's measure is a step in good direction. However, how well the industry builds up from here will have to be seen from here on. But getting those additional disclosures, getting those additional data points, I think it always serves everyone well in the industry across the forum, right? Whether it's a retail investor, whether it's an HNI investor, or you and I discussing out here, any bit of additional data or information helps us assess the scheme, the nature of the scheme, the true to label characteristics of the scheme, and along with what you rightly mentioned, the ratios, the volatility ratios, the liquidity ratios, and all those things. I think those are all very well taken steps. This kind of transparency was much needed in the industry, and I'm glad we have a lot coming out.
Absolutely. Well, the starting point, I'm sure you've already caught the headline, but if you haven't, one of the biggest new additional data points that we have today is that we will know the number of days that it's going to take any mid-cap or small-cap fund to liquidate, to sell down its holdings to the extent of 50% of the portfolio and 25% of the portfolio. Why should we know this? Because just in case there's a big market fall and fund managers have to meet redemption pressures, they need to sell down their holdings to give us our money back, we should know over how much time period can we get our money back. So Feroze, first thoughts again, because as a broad premise, this seems like a step in the right direction. But, do those number of days, does that disclosure really tell us the whole story?
Good afternoon, Surabhi. Like you said, of course, this is like Mohit also mentioned, it's a great step of extra disclosure. Point one. Does it tell the full story? The answer is no. Can the first step itself tell the full story? The answer is no again, because it will take some time to develop something. But it's a great step to give a number in terms of number of days to understand liquidity risk, because that's the most easily interpreted numerical integer from an investor standpoint. How long will it take for you to liquidate 50% of the portfolio? That's point two. So very good variable, layman-ish kind of variable. That's great. Now, third, the stress test actually is a pleasant surprise for me because if you look at the small cap space, 60 days is the highest, which is SBI small cap fund, 60 days being the highest to liquidate 50% of the portfolio. A portfolio built over 10-15 years of existence takes 60 days to liquidate. That's in your small cap space. I think I'm pleasantly surprised, whereas one fund says it will take me 13 days to liquidate as per the formula. To liquidate 50% of the portfolio. And we are speaking of small cap funds, mind you, and I'm very pleasantly surprised with the liquidity, with the assumptions, of course, that the volumes would go up 3 times. And Surabhi, I think you have completely dug deeper into this. I think I should ask for your interpretation because I learned a couple of things in my interaction with you.
But it is your show, so it's all about your questions. So let me bring in my first viewer. We have Nitin Srivastava joining in. Nitin, hi, and welcome to Let's Talk Money. What's your question?
Hi, this is Nitin Srivastava. I'm working in a private company and also active in share market for some years. My query is why SEBI has targeted only small cap stocks, whereas the valuation is high across all segments, whether it is large, mid, small, or any. So, by naming only small cap, it is disturbing the whole sentiment there. Please guide me on this.
Mohit, your thoughts? Was this even needed? Does it really serve any purpose? And what the overall sense? I mean, there is a sense of trepidation, some hesitation now with mid caps and small caps in general. So, what do you say?
सुरभि, आई एम रिमाइंडेड ऑफ अ वेरी फेमस कपलेट आउट हियर कि हर दूसरे के पास अपने अपने मायने हैं, एक दूजे के लिए नहीं बट दूसरों के लिए आईने हैं.
Oh, okay.
It was an industry which was cluttered with multiple thoughts. There wasn't a very uniform way of assessing the risk across the small and mid cap schemes, right?
Sure.
And why small and mid cap schemes? To be very honest, that's the segment which has seen massive run up last year, right? The small cap index per se was up almost 48%, mid cap index was up almost 44 odd %, and the regulator and various other industry experts have highlighted the risk of a froth developing or a bubble kind of a scenario in the small and mid cap segment.
Yeah.
So I think SEBI has taken the right step. I understand that the valuations on the large cap front also would have soared, but when you compare it with small cap, the liquidity risk, which a retail investor is not aware of, is the highest amongst the small and the mid cap zone. So was it required? Yes, it was required. Additional disclosures are always more than welcome. However, how will it help? As you rightly said, you will have to club that information with the AUM of the scheme, with the market cap breakup of the scheme as to how well the scheme is running. Is it a true to label small cap scheme, right? So you will see a lot of small cap schemes running 85, 90, 95 odd % small cap allocation. And perhaps that's the reason which is leading to higher number of days on the liquidity front. So you will have to club a lot of this information, and for a meaningful outcome to emerge out of this, you will have to put this entire sheet together, club the ratios, and perhaps this is a way of elimination and not a way of selection.
Fair enough. So, I want to get started with this exercise, and we will pull up some of the tables. What we've done is, for the sake of clarity for our viewers, we've divided this into two buckets, small cap funds and mid cap funds. So let's start with small cap funds because that's where the biggest hype is on risk, etc. And you can see on your screen there that, now, technically speaking, SBI's small cap fund is taking the maximum number of days to liquidate 50% of its portfolio, which is 60 days. Then comes the HDFC small cap fund. Then we have Tata. Now, Tata, by the way, the size is a lot smaller. The SBI small cap fund is over 25,000 crores. The Tata small cap fund is not nearly as big in terms of size, but as you can see, it's still taking about 33 odd days. So Feroze, come in on this, because here we have to marry the number of days with the size of the fund as well, right? Because typically bigger the fund, the longer it'll take to liquidate. So how do we sort of arrive at a consensus of what really is risky and what is only the nature of the fund? Because it's a big fund, it'll take longer to sell.
Great. So one, like you rightly said, there is something which is logically making sense that a bigger fund should take longer to sell under the same assumptions. And if you're giving 10% of the total volume of that day for that fund, then of course the bigger ones, like you rightly pointed out, Tata, for example, is eye-popping, right? It's a small fund and it takes the third largest time to liquidate 50% of their portfolio. So now how do you dig deep? Now, if you look at it, if you look at the weighted average free float of the stocks which are there in Tata is about 49%, which is one of the lower ones. Second, it has 10 stocks less than 3,000 crore market cap. Which is far too many with respect to the relative comparison with the rest of them. So they have even 3,000 crore market cap stocks, which might have a free float of even 800,000 crores in their portfolio, and 10 of those. Only 4% of their portfolio is an F&O exposure, by which I mean 96% of the stocks or weightage of the stocks which they own is not there in F&O. So like you said, Surabhi, the headline number tells you where is more investigation needed. And like you rightly spotted, Tata needed investigation. That's why I'm throwing up those numbers of free float, F&O exposure, and less than 3,000 crore market cap companies, which are a part of the portfolio to the extent of 10 of them being a part.
Okay, that's important. So a lot more other, parameters just beyond the size that go in determining why a fund could be taking more time to sell down its holdings. Mohit, just very quickly before we take a break, your thoughts on this, because there's this absolute number that we get, number of days. But like Feroze mentioned, there are other factors. How many stocks are in F&O? What is the free float, etc. And then come in on the market cap mix as well, right? Because now we'll know that even if it's a small cap fund, whether it is 80% small cap or whether it's 65% small cap. So how do we interpret this? Because in a bull market, small cap funds, which have a lot of good small caps, they'll always outperform. Okay. But now we are being told that small cap funds with some large caps are actually safer. Very confusing for the investor.
Okay, look, so my thought is point number one, 20% of the most illiquid stocks are already out of the computation, right? So one part is whether if you have a portfolio which is extremely small cap in nature or illiquid in nature, where the free float is very little, right? That portion is already eliminated. The test is being done on the 80% of the portfolio, the balance portfolio. Yeah. Now, when you club that, and in a way, even the AUM is accounted for, right? So even the AUM is accounted for in the parameters of the test. But the key criteria to my mind out here is to look at the market cap breakup. Just taking case in point, which is Tata again, Tata and DSP. If you check these two schemes, they are pretty smaller in size in the terms of the AUM which they hold. However, the small cap composition in Tata is almost 94% and even in DSP is almost 88-90% somewhere. Even for SBI small cap, the small cap component is very high. Contrast that with Quant. Right, the small cap component minimum has to be 65%, but if you see the other part, it's predominantly large.
And it's easier to sell those large caps, easier to get liquidity.
Absolutely. Yeah. So the moment you move away from the true characteristics of this, the scheme, right? When you're running a small cap scheme, I think an investor has to be extremely aware and cognizant what kind of a scheme he's going for. Whether if he wants a true to label small cap, mid cap scheme, then he has to compromise some inches on liquidity. You cannot have the best of all worlds, and perhaps you will have to then work around with this equation and figure out the best combination which suits your appetite.
Fair enough. What we'll do is we will illustrate this with an example, because after the break we have some more viewer questions and some of the viewers are asking about specific funds. So let's take up one or two of these funds as examples and see how we need to apply some of these new data points that we've got and then come to a conclusion whether it's a good fund or not such a great fund. Quick break. We'll be back in just a moment.
Let's talk money